All right, I am live. Welcome to the show. I haven't been on here a while. I just wanted to cover some tweets here. Elon Musk tweeted that he says double digit GDP growth is coming within the next 12 to 18 months. And then he doubles down and says, if applied intelligence is proxy for economic growth, which it should be, triple digit is possible in 5 years. Okay, that sounds like super fantastic. Like, is that even possible to be true? Let's look at the top highest years. So 1941 and 42 was like 17.71% and 18.89%. 1943, also World War II, was 17%. 1950 was 13.37. 1936, that was the New Deal recovery, was 12.88%. So all of those double digit years, those are the only double digit years we had, were excessive deficit spending. It was just pumping money into the economy. It was just stacking up debt to inject money into the economy. So how do we do this without injecting? How do we how do you even begin to debate Elon Musk on AI, right? Because he is the leader in it, and and I'm just this lowly realtor. So, but I have to question it. So how do I question it? Well, I'm going to use Elon's own software to kind of look at that, and that's where I got those top five highest years. Um, so all of those were deficit spending. There's been no double-digit growth since 1950s. Post 1960s, highs topped around 7 to 8%. It was 7.9% in 1983 during the Reagan era recovery, which also had a lot of deficit spending. So, is that possible? Maybe. I mean, let's kind of look more into what Grok has to say as I dig into this. Um, so, the theoretical pathway to get to AI-led growth versus deficit spending. So, GDP would equal consumption plus investment plus government spending plus net exports to spike without deficits. Um, the lift must come from private investment. Okay, so it would need explosive private capital expenditure and AI infrastructure, like hyperscalers, Microsoft, Google, Amazon, Meta, and then the chip makers, NVIDIA, TSMC. They'd have to ramp trillions into data centers, GPUs, and energy projects, to build the energy needed to run the AI. The current AI related capital expenditures already contributes about 0.5% to 1.1% of recent GDP. They'd have to scale this 5 to 10x privately. They could add several points short term. So, is it possible? Maybe rapid productivity translation. This is all Grok I'm asking, right? Because I'm not an AI expert. Agentic AI, autonomous systems, augments 30 to 60% of tasks and knowledge work. Manufacturing, healthcare, boosting output per hour, private adaptation, enterprise deploying AI tools. So it raised labor productivity 3 to 5% annually, and then compounding to GDP lift. Multiplier effects. So higher corporate profits would fund more R&D and investment. Wage gains from productivity spill into consumption, energy innovation. So it all kind of builds off of there. And that aligns with what Elon is saying. Now, the reality is it's unlikely because there is a lag time in productivity. This is Grok saying this. So Grok is challenging Elon's tweet here. No double digit precedent without stimulus, energy constraints, talent shortages, and regulations. Yeah, a lot of government regulations. I guess they're pretty upset with the AI centers consuming too much resources. So we have a shortage of electricity. Elon's applied AI along with, now let's just put it along with like Trump. So now I ask Grok to say, okay, take Elon's tweet and then add in the Doge cuts and half of what Elon said it was possible to cut on Doge, because he did inflate it, we'll assume. So cut that in half and then take all of the Trump tax law changes. So it ran a combined scenario. So baseline of 2026 GDP is 2 to 2.5%. And then adding in optimistic nets of AI, another 1.5 points. Tariffs, they put 0. I think you'll get something out of tariffs, but that's just me. And then Doge, they said another 0.5 point. Taxes, another 0.5 point. Excuse me. So 4 to 5% total. And it says to hit 10%, you need massive synergies. AI multipliers of 3x higher, tariff revenue, perfectly funding cuts without drag. So net add addition prior to scenario. So 4 to 5% optimistic baseline. When you combine the tariffs, Doge cuts, and Trump tax law changes, optimistically get to 6 to 7% GDP in 2026, which would be amazing, right? But it's not going to hit double digits, but it would be amazing economic growth. So then I asked Grok to say, okay, what is the most optimistic published 2026 US real GDP growth forecast? And then it ranked Goldman Sachs at 2.6%, Morgan Stanley expecting around 1.8 to 3.2%. And then Bank of America, 2.2%, consensus averages, professional forecasters, Philadelphia Fed, Deloitte, et cetera, 1.8 to 1.9%. So nowhere near that 5 to 7% or 6 to 7%, let alone even double digits. So we're going to just say it's unlikely we'll see double digits, triple digits in maybe the next 5 years. Yeah, if this is truly, if AI really does what they think it'll do, maybe. How does this impact real estate? So I have to go back to kind of the core of what real estate is. You know, it's housing is, I'm talking residential real estate, not commercial, but ultimately housing is dependent on jobs, right? It's not based on people, it's based on jobs. So if you have like Detroit was booming in the 50s and there was jobs galore, right? Manufacturing of the auto industry and all the auxiliary services there. So they had a huge demand for housing. And as Detroit slowed down and the manufacturing was shipped overseas and in other parts of the country, those jobs left Detroit and Detroit economy collapsed, right? The people left that area because jobs are. So jobs is the leading indicator on what is the demand for housing. So based on that, I kind of started asking Grok some of the key questions on where stuff is going to grow, right? So the key U.S. areas, regions where they're going to build these AI data centers, because that's where I'm going to focus in on where the jobs might be. So Grok gave me some answers here, and it said, established primary markets, high volume, ongoing expansion. So if you want to take some notes, here's some places to consider investing in real estate, and I'll dig into this a little deeper. It gave me Northern Virginia. I don't know how to pronounce it. Loudoun, Prince Williams, Fairfax counties. It's the world's largest hub, 300 plus facilities. AWS, Microsoft, Google expansions despite higher rates, 12 to 15 cents industrial. And those rates are the gigawatts. I didn't copy and paste this. I'm sorry. I had asked it about electricity because electricity is what's holding up AI, the data centers. So they need places they can get affordable electricity to run these data centers. The data centers will then grab the jobs, attract the jobs, which will attract the people, which will make housing demand. And if you're listening to this, you're probably investing into housing or at least interested in it. Okay, so it said Northern Virginia, Dallas, Fort Worth, Texas. Record absorption, hyperscale pipeline strong. Cyrus One Projects, QTS. I'm not sure who QTS is. Atlanta, Georgia, rapid growth with Microsoft and Google campuses. Chicago, Illinois area, I did not see that one coming. Strong secondary with new builds. Phoenix, Arizona, Vantage, Microsoft expansions. And then it broke it out to emerging high growth markets with notable 2025 AI focused projects. Wisconsin, Mount Pleasant, Racine area, Microsoft Fairwater. It's the world's most powerful AI data center in final phases. Meta, 1 billion plus AI facility. Ohio, New Albany, Columbus area. Amazon, Google, Intel, massive campuses, low cost power, and incentives drawing billions. Here's a sleeper, North Dakota, Fargo area, just north, Ellendale, Jamestown. Applied Digital's $3 billion Polaris Forge AI campuses. Leverage nation's lowest rates and cold climate. So one of the issues on data centers is heat. So you get the advantages of North Dakota with the cool temperatures to allow, cooling of, not have to provide additional electricity to cool it. Texas, let's see, additional sites beyond Dallas, Fort Worth, Anthropic investments, Oracle, OpenAI, Stargate related. Abundant gas keeps costs competitive. Okay, so Iowa, Des Moines, West Des Moines area, Microsoft multi-billion gigawatt scale AI campuses, low rates and wind power. And then New York, various upstates, Anthropic, Microsoft projects. Okay, so then I asked it to kind of break these down a little bit. So if you're going to start throwing money at it, you're going to want to dig into these markets a little bit before you start throwing money at it. And it's too bad, but my market's not listed on this. I wish it were. But I'm going to have to consider switching markets. Anyhow, Dallas, Fort Worth, Texas, top tier, strong buy for growth and yield. Overall market for 2026, commercial home building prospects, massive AI expansions, demographics, explosive population growth, 2 to 3% annual, job multipliers from tech energy, rents medium 2-bedroom 1,800 to 2,200. That's up 5 to 7% year over year projected. Cap rates 5.5 to 7% for stabilized multifamily investments. High absorption from in-migration. Target suburbs for 5 to 20 unit value adds. 15 to 20% IRR potential on BRRRR with financing at around 6%. Risks are supply pipeline could soften vacancies short term. Okay, so they're building a lot of housing, so it's saying that might be kind of a risk to also be a little oversupplied. Atlanta, Georgia, strong buy, balanced appreciation. Frequent top 10. AI growth with Google, Microsoft. Population growth 1.5 to 2%. Diverse economy. Rents are 1,700 to 2,100 median. Solid 4 to 6% escalations. Cap rates 6 to 7.5%. Pro landlord friendly laws. No rent control. Mixed use zoning. Favors rentals near tech corridors. Excellent for multifamily. NOI growth tied to AI jobs. Okay, Phoenix, Arizona, solid buy, high growth, moderate yield. Sunbelt staple. Let's see, Vantage, Microsoft AI. A lot of in-migration, population growth of over 2%. Rents 1,800 to 2,300. Median 5% growth forecast. Cap rates 5 to 7%. For suburban single-family rentals. Chronic undersupply supports appreciation, 8 to 12% potential. Okay, we'd want to dig into that a little bit more, but that Phoenix kind of jumped out at me there. Columbus, New Albany, Ohio, emerging buy, cash flow plus upside. Rising in 2026, best cities rankings. Massive Amazon, Google, Intel, AI campuses. Midwest affordability with population growth of 1 to 2%. Rents are 1,400 to 1,800. Higher yields. That's important. Cap rates 6.5 to 8%. Great parallel to Twin Cities because Grok knows where I'm from, so it's it's kind of caters towards me. Target 5 to 50 unit properties for strong DSCR, 1.4 to 1.6 times. And forced appreciation from AI spillover. So it also lists Chicago, Illinois, moderate buy, stabilized with rents, secondary AI hub, stabilized multifamily, cap rate 6 to 8%. It's got additional income or additional healthcare jobs and stuff like that. So it's a stable market is kind of what they're promoting there. Des Moines and West Des Moines, Iowa. It's a value buy, high cash flow. So Microsoft, GW scale. Let's see. population growth right around 1%, low unemployment, rents are 1,200 to 1,600, excellent yields. Okay, so now Des Moines jumping out at me because we can get a higher yield there. So cap rate 7 to 9%. Undervalued for multifamily, landlord friendly, quick evictions, prime for cross border extensions from my portfolio. Okay, so like I said, this has all of my information in it because I've customized my AI for real estate. Fargo, North Dakota, Applied Digital's 3 billion AI campuses, lowest US power rates fuel growth. Okay, so cheap electricity. Rents are 1,100 to 1,400 median, 4 to 6% growth from construction. Cap rate 7 to 9%. Very affordable entry, 200 to 300,000 medians. Low vacancy, 3 to 5%. Okay, so target Fargo multifamily for stable net operating income and minimal competition. Northern Virginia, Loudoun, Ashburn. Cautionary appreciation focus. World's largest data center hub, intense AI demand, but sky high prices. Rents are 2,500 plus, strong growth. Cap rates compressed 4.5 to 6%. High barriers, better for institutional retail investors. Low yields. Okay, Racine, Mount Pleasant, Wisconsin. Microsoft Meta. Anyhow, so those are kind of the key markets that it points out. And then you want to look at the number of jobs. So how they create housing demand or identify housing demand is going to be how many jobs in an area for every housing unit. And the target that a lot of cities want to see is they want to target right around 1.5 jobs for every housing unit they have. So that kind of lets them know how much infrastructure they should be releasing based on projected job growth. And sometimes they overbuild, sometimes they lag behind, but ultimately that's kind of the target range they want to get to. So I asked Grok to say, okay, take all of those markets and give me the current jobs per housing unit there and, rank them basically. So the number one rank was Dallas, Fort Worth, Arlington, Texas. It's 1.3 jobs per housing unit. So it's a mild undersupply. So undersupply is going to be like 1.6 and higher. So mild undersupply is high permits response among top builders nationally, but job growth still outpaces. Low vacancy, 4 to 5%. Rent vacancy, 4 to 5%. Rent growth, 4 to 6%. Good balance for cash flow plus appreciation. So that's a nice safe market, according to this metric. Atlanta, Sandy Springs, Georgia, 1.22. So it's slightly undersupplied. And cumulative shortfall from past underbuilding, tight inventory, rent escalations 5% plus, cap rates compressing to 6 to 7%. Strong demographic in migration. Okay, people moving into the Atlanta area. Phoenix, Mesa, Arizona, 1.14 jobs per housing unit, mild undersupply, high construction volume, but persistent shortage. Low month supply appreciation, 5 to 8%. Vacancies less than 5%. Favor suburban burrs. Columbus, Ohio, 1.25 undersupply emerging. Fast AI job growth tightening market. Rent growth accelerating. Low inventory. Watch for cap rate drop to 6 to 7.5%. Chicago, 1.23 jobs per house. Balance to mild undersupply, suburban strength offsets suburban urban softness. Vacancies 5 to 7%. Des Moines, balanced 1.3, good supply response relatives to growth, higher cap rate 7 to 9%, steady net operating income, attractive for cash flow without extreme tightness. Fargo, North Dakota, 1.24. They're saying it's balanced, adequate stock for size, low competition. Cap rate 7 to 9%. Stable rents, prime for yield in cross-border plays. Okay. Northern Virginia, 1.3. Severe undersupply, they're saying in Northern Virginia, the Prince William area, DC. I question that because a lot of changes are happening in DC. So low vacancy. Racine is 1.2 balanced. Okay, so it's piqued my interest on what markets to look into. I'll probably look into the Midwest here. That Dallas Fort Worth looks appealing. So that's kind of where I'm at with trying to figure out Elon's tweet here. I mean, to say we're going to hit double-digit growth, I mean, that's incredible. And if you're talking triple-digit growth, like he's talking about within 5 years, you're talking about doubling or tripling the economy. That's a bright future. And what does that do to housing? Does that ratio stay the same, that 1.5 jobs per housing unit? Or does that get reduced because of productivity, right? So if you can do 3 times the number of production, does that number go down by 2 or by 3, factor? That I don't know. Like, a lot of things are changing. If I can do 3 times the amount of work, just having AI run stuff, all my my minutia behind the scenes, and I get 3 times more productive, I'm not creating demand for 3 times more housing units, right? The productivity went up, the jobs didn't go up. And then does AI take away jobs? I don't think so at this point. I think it will in the future, but not in the short term. I think there's too much infrastructure to be built. There's too much learning curve with it. But at some point, I can see it where it starts to really get implemented and start taking away jobs. But that's a number of years down the road, in my opinion. But I'm not a genius like Elon Musk. So, it's kind of a bold statement I'm jumping on here to challenge Elon Musk's tweet. But, regardless, Elon believes that the economy is going to take off. And there's a lot of winds pushing it the right direction, right? We have technology. We have expansion of new technology. We have to grow the energy sector to bring that technology online. We have tax reforms that will incentivize investment real strong for real estate. Bonus depreciation. You buy a rental, you can deduct the whole thing the first year rather than over the 27 and a half years. That kind of stuff. So that's going to incentivize people investing into the economy and getting things rolling again. If interest rates come down, that's going to be like gasoline on the fire. And it's just going to take off because money's going to be cheap to invest in the infrastructures, invest into real estate, and get the whole engine humming. I do believe we're probably going to hit some of the best times this country has seen in growth, but I'm kind of optimistic too. Excuse me, I'm not a genius like Elon Musk and understand the technology he's dealing with, but I do see a lot of growth there. And I'm very bullish on it. I want to, like, right now, AI has totally decimated my productivity. I jumped on this morning and I saw the tweet and I went down rabbit holes and I spent probably 4 hours of wasted time asking Grok and AI all these questions. And what I just read off to you there was just a synopsis of it. I was running down pointless rabbit holes because the information's readily available. So my productivity just plummets, right? Now, will that productivity catch up maybe at some point? Because I did probably, add a lot to knowledge base like I never thought about before. So will I ever, capitalize on it, invest in the right market, something I learned here that I don't realize I learned that may, help me down the road, probably. But right now, the return on investment is very low. I'm not, selling widget A to widget, whatever to customer B, that kind of thing. I'm not generating cash by digging into it, but I'm building a base. Now, if I can learn how to operate it, so I'm investing a lot of time up front trying to learn how to understand it and then somehow implement it. And one of the ways to implement it is to use it to expand the knowledge base, kind of like what we do on YouTube and stuff like that. We share our information and try to learn from each other. So, there's going to be exponential growth from it. It's just how quickly. Like, Elon Musk is probably spot on the numbers, but it's going to happen in the next 12 to 18 months. I don't know. It could. That's a pretty short time frame. So, okay, that's all I had. I just wanted to try to make some use of my rabbit hole 4 hours of non-productive time this morning trying to figure out what Elon's tweet really meant. So looks like we got some questions here. Thinking time, and Roberts is on. So Merry Christmas, Roberts. How are things going? Do you guys have any questions? Okay, so I got a question here. Looking at real estate that has both a house and a decent sized garage, I can change up into living space. Might even build a hallway between them for harsh weather. 2-for-1 idea. Okay, so yeah, that's taking a property and improving it. That's how you make money in real estate. You somehow increase the rents or increase the value through forced appreciation. Expanding square footage is one of those ways. The trick on the garage spaces is going to be codes. Can you do it in your area with getting the proper heating in there? Do you have the proper footings in the garage? That kind of thing to add legal living space. But that's the exact train of thought you want to increase value. Can you share more on what you're working on there? Do you have that information, or is it just a concept at this point? But yeah, adding square footage, a great way to do it in the Midwest. We have a lot of basements in Minnesota. And the reason we have that is the frost levels. We have to go down 42 inches to get below frost level. So you just add a few more courses of block and you got full basements. So that's what happens. And then you can easily finish off that basement space for added square footage. Okay, so yeah, he just replied. It's got it's concept only. So he's just kind of kicking around the idea. It's got a lot across the street also for sale. Now lots are tough to cash flow. They're kind of, you buy them and they suck up money because you have insurance on it, you got taxes to pay on it, and you tie up some capital. Depending if you're in the path of development, there can be very strong future values. So that kind of depends on what you want to do with that play. If you want to build on a house, kind of the general rule of thumb is banks want to see about 4 times the value. So that means the lot can be about 25% of the total package value, give or take. Now that number can fluctuate. Like if you're on a lake, that land can exceed that 25% pretty easily because the land is the higher value. So you could buy, like in Minnesota here, Lake Minnetonka, you could pay $2 million for a lake lot, and then you could put up $1 million house on that, and that ratio would work. But if you're in the suburbs, your traditional housing stock, you're going to want to be that 25% value. So let's say the total package is going to be right around that median price of give or take 400,000. That means you can probably pay about 100,000 for that lot. You might be able to go a little bit more depending on what your permits are. If you got to clear out any trees, any site work, that kind of thing. If you have a challenging site to work on, a lot of infill sites might have a steep slope on it. Or like some wetlands where you got to run some borings down there to stabilize it. So those kind of have to factor into that land cost as well. So I would take a look at that lot from that standpoint. I do believe there's going to be a housing shortage. I believe there is a housing shortage, especially if we looked at the job numbers, if we get job growth like we think, but we don't know where AI really goes. But you kind of look at your local market and you can tell if prices are increasing, decreasing. That's that kind of supply demand ratio. There's a huge market for doing what you're doing. You're taking an old product and you're adding to it. You're increasing the value, making it more livable, more usable, or you're taking raw land and you're turning that into housing, which is needed. So that's where you make the money in real estate, is you find the undervalue and you create value out of it. And that's building a house, or that's improving a house, or expanding on the square footage of the house. Okay, we got a pessimist here. So We think there's going to be a depression and not a recession in 2026. Will not be a better business environment. Um, I can kind of see that, depending on what you're looking at. I see interest rates dropping, so I see more demand. I see technology increasing, so I see more demand there. I'll see job wages. I do think we're going to see those increasing. The labor market is a little bit loose right now. I know some guys that are looking for work, but they're in that higher. They're in my age bracket, right? They're in that 50 age group, and these companies tend to lay off that age bracket because we're higher paid, and they can replace a lot of what we do with younger guys that are going to work for less, or women that'll work for less. So once you get into that mid 50s and you get laid off from a corporate job, you're kind of hosed. It's hard to find a replacement job. So that stuff I think is kind of weak right now. And I think a lot of, reining back. I think we're through the worst of the high interest rates. I think those are going to start coming down, and that really reined it in. We had a lot of hangover from that, the COVID injection of money. A lot of money got injected into the system, paying people not to work, to go to the office, that kind of stuff. And then that kind of reared its ugly head, and, it ran that inflation high. And then rates had to go up to try to rein that inflation in. But I don't think we're going to see a depression. Had you asked me that in 2022, my prediction was actually we were going to see a 20% drop in house prices. I was way off. I just thought more people were going to be forced into selling. But the reality was is people didn't have to sell. They had low interest rates. They couldn't afford to live anywhere else because their monthly house payment was cheaper than rent. So they stayed put. So they did whatever they had to do to keep that. Plus there's a lot of safety nets in place. So there was no forced sellers to drive that house prices down that I thought we would see. So I was wrong on that one. But now that we're coming out of this, I see nothing but strong headwinds for the economy. I see a lot of business incentives to reinvest into the economy and into businesses. And I think that'll really kind of come roaring through in 2026. So that's my take, but I could be wrong. So. And then you also have to consider what you consume and content. So there's a lot of people out there that I'm going to call them doom, fear porn, that kind of stuff, that talk about housing crash, and it gets clicks, and it may not be accurate, right? But they make money off of that. And I'll be honest, I got sucked into that back during the housing crash. I was in real estate. I was sitting on 150 units, partnered on 150 units, and they were resale condos, and the whole market collapsed, right? That was all my booked revenue for the next 2 years. And then I got sucked into the negative. Like there's a lot of negative there, and I focused in on that. It was real hard for me to get back up and get going again. So just kind of what you're listening to and what you focus on, tends to expand. Okay, so he expands on the thought here. 1, people not getting married. 2, less people having children. 3, less people starting new businesses. 4, less businesses expanding. 5, government spending too much, private sector collapsing. Yes. So let's address each one of those. Those are all valid points. Okay, so people are not getting married and they're not having children. Okay, what does that do for housing? Okay, boy doesn't marry girl. Boy buys a house. Girl buys a house. Twice as much demand for housing. Now, the housing units aren't probably the same. You probably don't get that 3-4 bedroom. You don't need that. You're a single person, or you're going to have a roommate. So you may go into a 2-bedroom. You may go into, a townhouse or a smaller house, that kind of thing. So the style of housing is changing, but the demand for housing has doubled, not, right? Because if you marry, you're going to consolidate housing. Divorce, you're going to split housing. So if you don't get married, you're creating twice as much demand for housing. So that's the answer to that one. Having 3 less people starting, so having less children is going to reduce the type of housing that's needed. So that will change. And then that's going to be where your creativity will come in on how do you meet that new demand, right? Because as a real estate investor, you're going to want to meet the demand with providing the housing solution for the market. And the market's changing. You're dead right on that one. So, less people. So 3, less people starting new businesses. Okay. Why are they starting fewer businesses? One is the cost of money is too high, right? When you have to go borrow 7% to go borrow money versus when you could borrow it for 4 or 5% or 6%, that makes a huge difference on your return on investment. So as rates come down, investment into buying businesses and starting businesses is going to increase. Plus, with the new tax law changes, you get bonus depreciation, you get accelerated depreciation, you get a lot of tax incentives for starting these jobs and this revenue. So that is going to start changing. We're seeing that change now. I think we're going to see a lot more of that going into 2026. So that is going to the positive direction. But it's a valid point. And then number 4, less business expanding. Okay, that goes back to the investment, right? And that goes back to also market forces. When you have high interest rates, you have high interest rates because you're trying to slow down inflation. So you're trying to slow down the velocity of money. So you're not bidding everything up. So you're constraining the money flow. So that slows down people's spending, which then slows down jobs expanding, right? Because the demand's dropped. So they're not going to invest as much. As that inflation, we're down, I believe we're pretty close to 3% when you take out housing, or 2% when you take out housing, because that's a lagging indicator. You're going to see more investment going back in because people's incomes are going to start to go a little further again. So that is changing as well. And once that synergizes and starts to build off of itself. But you're right, the last few years we've been compressing, and it's been hard the last few years. That this inflation's been real hard on everyone. But that trajectory's changed. We've hit that bottom. We're coming back up. 5, government spending, too much private sector collapsing. Yes. So that's that gets into those macroeconomics. So I forget the name of the word for it, but the government spending crowds out the private sector, and it's good money after bad. So the more the government spends, the more it's chewing up resources of the private sector. Absolutely. So when you had Doge, and that's why I put that into the AI earlier, is the Doge cuts. Elon expected all these trillions of dollars to come out of Doge. We haven't seen it yet. But what we are seeing is, in my home state, we're seeing fraud in the billions of dollars, right? $7 to $8 billion that they think they have identified to date, right? And this has only been a few weeks now. And now California is starting to come out, and they're like, I don't know, 17 billion or something crazy. I mean, they're the fraud that is being shoveled out there, that's being exposed. And if that can get cut off, that's the parasite that's dragging down the economy, that's dragging down the private sector, that's hurting everybody's paychecks, because that's money and resources that's being consumed to pay for something non-productive. So that is starting to be targeted. As that starts to get cut, that lightens the load, and that should generate more income. So all of yours are valid points. I just think they're heading the other direction. We're not getting worse. It has been getting worse the last 3 years, but we're coming out of it now. A lot of policy changes have happened. We're starting to see that fraud exposed, which hopefully they stop the fraud and stop that bleeding of that money from the private sector. And it can go back to the people that are working, and then we can be more productive. So that's my optimism. But I understand the pessimism. But try to look at more of the bright stuff, because it's easy to get sucked down in negative stuff. And those are the headlines that draw us into it. And like I said, in that housing crash, I got sucked into that doom and gloom, and it was very hard to pull out of. So try not to go down to doom and gloom. Try to look for the opportunities. So, all right. Any other questions here? We're rolling on 1:39. I'll probably log off here any minute. We don't have any further questions. So glad you could jump on. Want to wish everyone a Merry Christmas, and getting back onto my schedule here. I've got diverted with a lot of personal stuff. I can get into more details. There's going to be some posts about it with the aging population. I've got family with the aging issues I got to take care of, and then just with the work stuff, and it just on and on. It's never ending. So I kind of hit the point of exhaustion, being pulled in all different directions. But I am recommitting to getting back online here and trying to post some good content. I'm going to run down a lot of rabbit holes because I'm trying to use this to learn, and I'm going to try to tackle some subjects that I probably am not an expert on, like AI, but I'm going to try to answer it the best I can. And, chime in if you think I missed the point or you want to add into it, would be fantastic so we can learn from each other. All right. Well, Happy New Year. Cigar time. Sure. I don't smoke cigars, but get in touch and I'll join you. I have a little nicotine addiction problem that I can't pick up the cigar, so it'll get me smoking again. So, but I appreciate the offer. But yeah, message me. We'll connect. So talk to you later, guys. We'll see you soon. Have a good one.